In Half Moon Bay, California, live from the Techonomy Conference, where we are talking about the future of technology. Guests from around the world in tech are gathering here to talk about how technology can change the world for the better, in particular by helping accelerate progress toward the UN Sustainable Development Goals. We've got a great lineup ahead for you, including an exclusive interview with Micron CEO as the company rests in the crosshairs of the U.S.-China trade spat. Now, first off, our top story, shares of Apple and some of its major suppliers falling. Investors concerned about new signs of weak demand for iPhones. Lumentum Holdings cut its forecast after one of its largest customers asked to reduce shipments. Lumentum didn't name the customer, but Apple is its biggest. Lumentum makes components used in Apple's Face ID. Joining us now with more, who else but David Kirkpatrick, founder of Techonomy in New York. We're joined by Ryan Vlastelica covering this story for Bloomberg. So Ryan, what exactly do we know here?
Well, right now we don't know too much. We know that there was a big, like you said, a big cut in the outlook, and some analysts have speculated that this could mean a 30% cut in orders from the point of view of Apple. Now, this builds on a lot of other concerns that we've been seeing about what iPhone demand is going to look like from here. Last week, we had a report out from Nikkei talking about a canceled production boost for the XR line of the iPhone. And before that, we had Apple's fourth quarter results, where it said it was going to stop releasing the number of units that it sells each quarter, which some analysts interpreted as a sign that maybe unit sales weren't going to be that strong going forward.
So, David, this doesn't mean that iPhone demand is going to be bad. It just means it's less than perhaps Apple expected and what Apple told its suppliers to prepare for. You know, how serious is this for one of the most transformative and important technology products in the world?
I don't see it as that significant. I think, they have raised their prices so they could sell less units and still make more money. And in fact, we've got to remember the iPhone and Apple are the most catalytic company in technology, consumer technology. They are not going away. I think they've actually been unduly hurt in this recent downturn in tech stocks compared to their potential vis-a-vis some of the others.
Ryan, what do we know about Lumentum? They make components for Face ID, which, is now in 3-4 iPhones. So we're talking about a range of phones, not just the XR, which is what the Nikkei had reported. There was some production issues there. What exactly does Lumentum do?
Well, like you said, they're heavily involved in the technology used in the Face ID. Now, a lot of other types of phones also use similar technology, and some analysts have speculated that they could maybe get a boost from Android phones. But for the moment, they are so heavily tied to Apple. I think they get about 40% of their revenue from Apple last year, that if there's weakness here, it's going to be very important for them. It's going to be, like you're seeing today, the stock is down about 30%. It's its worst single-day drop ever. Clearly, this is something that investors are very concerned about.
Now, David, you covered Apple for many years, and you know that any sign of any information about production of the iPhone gets dissected because, we don't hear from Apple until the end of the quarter. Now we won't be getting numbers, specific unit numbers from Apple about the iPhone at all. It makes sense if you think about the company shifting towards a services company. But can Apple live up to its $1 trillion market value as a services company?
That's a really big question, but I do think the market seems to be overreacting to this little bit of hyper-magnified news, given the general situation that Apple still has in the consumer technology economy. I don't think it's nearly as worrisome as it's being interpreted.
Why not?
Because I think Apple has a number of other products and a number of other things happening. I do think their services business has a lot of potential. Look at the AirPods. That's a $179 thing that now everybody on the New York subway has, and it's got to have gigantic margins, even if they won't tell us what the margins are.
Right, they won't tell us, which is part of the problem.
But still, and the Apple Watch with the EKG in it, these things are significant. These are transformative. Apple is still at the front of consumer devices globally. That will continue to pay off. In the macro, the stock day in and day out. That's not my expertise, but I absolutely feel in my gut this is an overreaction.
Now, Ryan, overall, we've seen FANG stocks take a beating over the last couple of weeks. Do we see any sign of that changing now that we're through the midterms?
Well, these stocks weren't the ones that are going to be too impacted by the midterms. I mean, you will see Facebook and maybe Alphabet if there's a move towards privacy and data regulation, that kind of thing. I do think you will see some analysts come in and try to maybe see if they can find some bargains. I've certainly talked to some semiconductor analysts who are looking for opportunities here and think they see some really good values following the big drop that was seen over October and going on into November. But again, like, the fact that there is slowing iPhone demand is Apple is such a big player in the entire tech ecosystem that this is going to be felt broadly.
So, David, here at Techonomy, you're talking about the future of technology. The iPhone is a huge part of tech's transformation because it enables that transformation. How does this fit into some of the themes that you're talking about this year?
Well, the iPhone is the catalytic device that changed computing, changed consumer experience of technology, because going mobile, which really the iPhone inaugurated, has changed everything. So what we talk about here at Techonomy is the many ways that society is being transformed and the opportunities that creates for business. They're gigantic. But we're also talking a lot about the need for a new attitude of responsibility and conscious capitalism from the technology companies, because they really are not having the kind of reputation they used to have. John Chambers said this morning that in his travels in Middle America, Silicon Valley is viewed negatively today. That's very serious. So we're talking a lot about what can technology continue to do to change the world and also improve its image.
You know, Apple's been doing things to combat addiction. Facebook, Google, Amazon, they are all part of this sort of new tech-hating era. You know, do you think that this is a prolonged state of being for tech? You know, do you think that the anti-tech fervor continues for the foreseeable future?
I think the anti-giant tech fervor is going to continue. I've played part of it with Facebook, which I'm very critical of. But in general, technology is going to be doing great. Its reputation will improve over time as innovation helps.
So how does tech help us get towards a more sustainable future?
Well, tech is going to help us get toward a more sustainable future. There's ideas galore at this conference.
All right, David Kirkpatrick, founder of Techonomy. Always great to have you. Ryan Vlastelica for us in New York. Thank you both. We'll continue to monitor this Apple story, of course. Now, the Trump administration is debuting new tools to fight China's alleged theft of American intellectual property. The Wall Street Journal is reporting that the U.S. will use export controls, indictments, and more as part of this new strategy. This coming after the Chinese chipmaker Jinhua was accused of stealing tech secrets from U.S.-based semiconductor Micron. The Commerce Department banned exports to Jinhua Monday, and we are going to have more on this later in the program when we sit down with Micron CEO Sanjay Mehrotra, who is here today at Techonomy. Coming up, 2018 is drawing to an end, but a strong year for IPOs set to continue. We'll discuss some of the biggest tech public offerings and acquisitions expected in 2019. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Welcome back to Bloomberg Technology at the Techonomy Conference in Half Moon Bay, California. Talking about IPOs, SoftBank's mobile unit will soon join the ranks of several strong companies that have hit the public market this year, most notably Xiaomi and Spotify. And as the year draws to an end, 2019 is shaping up to be an equally strong year for IPOs, with companies like Uber, Lyft, and Airbnb openly discussing their ambitions. Here to discuss, we have EY's global leader for tech media and telecoms, Greg Cudahy. Greg, thank you so much
it's great to
for
be
joining us here.
Tough place to be on a work day.
Given the year that we've had, what does the IPO market look like in 2019?
Well, I think, just as you said, if we've got anywhere from a flat to up market, you're going to have a strong IPO year.
Yeah.
There's just no question. Some of the big names are really going to come out this time. I also think that you're going to see some emerging things around autonomous and cyber that are going to accelerate, potentially becoming unicorns themselves in the next year or so.
But Are we going to be in a flat to up market if all these tech stocks are still down?
You know, it's an interesting question. I guess it's all relative to expectations. I think relative to a long-term period, yeah. And I think people are not necessarily looking to this year. They're trying to forecast a couple years out. Is it going to be worse? It's a gamble, whichever way you're going to do it. But I think in terms of the broad market, people feel like this is going to be as good a time to do it as any.
So Uber, Lyft, Airbnb, are those the ones you're watching?
Yeah, absolutely. No question about that. Those are the big names. But I think you're also going to see some acceleration of a bunch of mid-market players to try and get ready before the end of 2019.
In what particular areas?
Mostly cyber. And unfortunately, some of them are our clients, so I won't say them by name. But I think cyber is the one thing that's interesting because everybody talks about the growth plays, but cyber as a defensive play. I mean, if you don't have good cyber capability, frankly, you get picked up early stage in a lot of the cyber capabilities. So that's one of the reasons we're seeing so much growth in cyber.
What are the chances that all three of those companies, Uber, Lyft, and Airbnb, do pull the plug?
You know, it's an interesting question. I think the likelihood is it's going to be as a group.
Why?
One way or the other, because I think they're all going to be looking at market conditions that look at, you know, similar views as to what the market conditions are going to be like. If the market conditions are good for one, all of them have good business models. Right? So if the market's really, really down, though, I think they may want to push.
So then what's your outlook for valuation?
Well, valuations are high, right? But I think, you know, it reminds me a little bit of the go-go late 90s. But I think it's very different this time, is the business models were very speculative in the late 90s. You were kind of rolling the dice on a lot of these things. Some people were rolling the dice on whether the internet would even work. Now business models prove out really fast. And none of these companies is in a position where people don't think that they're going to be survivors. So as businesses, it's quality. Now the valuation thing is, I think that's a lot of other people need to speculate on that, but the long-term health of these things, I'm a long-term believer in the global economy and the U.S. economy. If you're going to jump in now, maybe it won't be a giant supernormal return for 3 years, but over the long term, it's going to be really good for people.
Well, I wonder if we're seeing a little bit of air come out of a bubble right now.
Yeah, I definitely think you are, and I actually think it's healthy. I think the fact is that there is a limit to how much growth there is forever.
So are we in a bubble then?
You know, it's tough to call it a bubble in my opinion. Yeah. I think it's probably an extended correction. I think it's very healthy to go ahead and make sure that the old irrational exuberance doesn't come back. I think this is probably a little bit of rational exuberance with the occasional irrational thrown in.
What sectors are more ripe for M&A than public offerings?
In terms of within tech or then, okay, in M&A, I'll go back to the cyber thing. Actually, I think people are trying to scale cyber, but the fact is they get picked up really early. It's really about algorithms. Some of the other big plays you've seen this year are really more about capability and things like collaboration and experience. If you saw SAP's Qualtrics acquisition,
right, we're going to talk about that momentarily.
That's all about experience. If you look at the collaboration with GitHub, if you look at the collaboration with Red Hat, those things are not about feature function. So I think you're going to see big M&A continue like that, by the way, no matter what the market, because there's a lot of cash out there. So when it comes to the M&A thing, a down market might actually make the M&A market even more attractive. Last
year, this time, we were talking all about crypto and ICOs, which have really calmed down. What does that market look like in 2019? So
that's, to me, let's talk about blockchain. First of all, crypto, I think there's a couple of dominant ones. They may or may not survive. I think it's been a very important beta for blockchain overall, is what can you use blockchain for.
So you think even some of the dominant coins won't survive?
Well, we've already seen a number of them go down to, you know, the absolute bottom valuation since they started. So, but there's, you know, the whole point of Bitcoin, et cetera, is that you create something that has a limit. But if you keep introducing more and more ICOs, that gets past the whole limit idea. So there's going to be some survivors. There's going to be a lot that don't survive. But the thing that's probably missing is this quiet revolution of blockchain using it for other purposes. InsureWave in the insurance industry, where you're actually dynamically repricing insurance for ocean freight. It's not exciting, but it's billions and billions of dollars of value to the industry by using blockchain for things like that, or royalties and rights management like Microsoft is doing across the industry to actually use artificial intelligence and blockchain to manage royalties and rights management. Pretty important in your business. And so there's a lot of that's not discussed, where there's a heck of a lot of value to be gained in the industry.
There's a theme of this Techonomy conference, one of them is responsible growing, and there's a lot of concerns about regulation, there's a lot of concerns about lack of transparency. How much do you think that'll hold the sector back?
You know, I listened to your previous speaker, and I think it's not just a great question, it's something we've all got to be on top of. And I don't think we want to leave it to just the regulators. Yeah. I think this is something that those of us in whatever role we play in the industry need to get on top of. I think in particular, you're going to see some questions. We've talked about privacy. We've talked about the, oh my God, AI is going to eat my brain. Those are probably getting more coverage in some ways that they're already being acted upon in terms of ethical use of AI and things like that. But what I don't think is getting enough coverage is how fast tech changes things. So take the trucking industry, where you've got 3.4 million just in the US truckers, nearly another 5 million people who work related to trucking, and then an entire industry of roadside restaurants and things that depend on truckers. That's nearly 10 million voters. And if autonomous, when it comes, goes really fast into trucking, if we as an industry and a public partnership don't have a plan on how to deal with those individuals in a rapid change, we're going to have another controversy on the ethical use of technology. And I think, you know, sometimes disrupted becomes disenfranchised, and I think we all have a duty to kind of work together on that as a collective community.
EY's global leader for tech, media, and telecom, Greg Cudahy. Thanks so much for stopping by.
It's great.
Good to have you. All right, coming up, SAP announces its biggest deal yet at $8 billion. How survey software maker Qualtrics will help the European company take on Salesforce next. This is Bloomberg. Welcome back to Bloomberg Technology at the Techonomy Conference in Half Moon Bay, California. On Sunday, SAP announced it's buying survey software company Qualtrics for $8 billion in its largest deal yet. The move comes just days before Qualtrics was set to go public as SAP looks to battle rivals like Salesforce. The deal values the SurveyMonkey rival at 20 times its revenue this year. Bloomberg's David Weston caught up with SAP CEO Bill McDermott and Qualtrics CEO Ryan Smith to discuss.
This is the jewel in the crown of SAP, yes, and it does change us fundamentally. There is a huge new category called experience management. Customers today want to protect their brands, their customer relationships. They want to inspire their people to be all focused on what's going on outside the company, and they want to understand in real time the sentiment analysis of everything that moves across the value chain in their business. So this is experience management. And Qualtrics is the de facto standard in this space. Now, SAP is the standard in operation management. The whole data around operations, 77% of the world's transactions run SAP. So if you can marry operational data with experience data, you have the holy grail of enterprise application software. So this is a bold move. It's all about growth, and it's all about the unique synergy of X data and O data, experience and operational data coming together on one platform to fundamentally change the world.
And Ryan, what about from Qualtrics' point of view? I mean, you were going forward with an IPO. The reports are that, in fact, the price you got was substantially above the high end of that. Did you go with SAP because of price alone, or was there something else? Do you think it's more valuable in SAP's hands than as a standalone company?
Yeah, so, you know, we were scheduled to ring the bell on Thursday, and I think this is a little bit of shift. I came home for the weekend, and things moved pretty quick. So kudos to Bill for acting quickly and having an enormous vision around what we're doing. Look, we've never optimized for finances. We were the company that bootstrapped for 10 years before raising outside funding. We've been cash flow positive. Even going public, we had no financial reasons to do it. We had cash in the bank. We were going because we've created this new category. And when Bill showed up and said, hey, look, take a look at our business where we've got all of the operational data. What do you think if we added the experience data on top of it and we reshaped how CRM is built, if we reshaped how ERP and the way we bring the customer into building products with real-time feedback in the product development loop, and we change the way employees interact with ACM because we power a lot of the employee engagement, employee experience of the world, it's a once-in-a-generational opportunity. opportunity. We get 15,000 sellers overnight, and we get to go global in a way that XM should be. Every organization in the world will have an experience management solution or an XM solution, and it's only being offered through SAP, and we couldn't be more excited. I've been doing this for 16 years, and it is just the beginning for me, and I woke up this morning and said, wow, I haven't felt this way since we were in the basement.
So Bill, I haven't read anything that doesn't say this is a good theory. Strategically, it's a good theory. The question has been about the price, because it is a very rich price. 20 times revenue is right up there. And they were already projecting, as I understand it, Qualtrics was a 40% growth in revenue. What do you need to deliver with Qualtrics inside of SAP to justify that price? Does it have to be 60% growth, 80% growth, 100% growth? What kinds of numbers did you pencil out?
Yeah, so a couple things. First of all, let me give you the details on the price. It's 13.5 times 2019 revenues, which is consistent with the benchmark for high-profile cloud companies in this environment. So that's number one. Number two, they're growing at 40% on a year-over-year basis. So this is a pristine cloud company in the experience management category that's fastest growing. SAP is also growing our business in the cloud by 40%. So if you combine two 40% companies, oh my goodness, this is the fastest growth story in the enterprise application software industry in the cloud. Now let's add one other thing. Ryan has 9,500 customers, okay? SAP's got 450,000. We're operating in 193 countries in the world. 22% of his revenue is outside the U.S. Now light that growth fuse all over the global economy and see what you get. We also go to market in 25 industries. So we have 15,000 salespeople in 25 industries that are now selling Qualtrics day one. Light that growth fuse. So the business case can be achieved with Ryan just maintaining his constant growth rate out into the future, and SAP doing the same. So last night I had an analyst call, and let me tell you what I told him. I told him, we're going to be the fastest growing business software company in the world, in the cloud, number one. Number two, count on us for double-digit total revenue growth. Number three, total operating income growth at double-digit at a rate greater than the revenue growth. So the design of the company is built around that, and all I need in the business case is for Ryan Smith, this great innovator, this fantastic CEO, and this amazing company called Qualtrics, to just keep doing what you're doing and don't stop, and use all the infrastructure and the power of SAP to spread your word everywhere in the world. All he has to do is that. He does that. This is the biggest and most successful M&A move in the history of business software.
SAP CEO Bill McDermott and Qualtrics CEO Ryan Smith with Bloomberg's David Weston. Coming up, sizing up Singles Day, why Alibaba's record-breaking day came with some warning signs. We will discuss next. And later in the program, we'll speak to the CEO of Micron, how his company is the latest at the center of the U.S.-China tech dispute. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in Half Moon Bay at the Techonomy Conference. Alibaba posting a record in sales at its annual Singles Day event Sunday. The company notched $31 billion in merchandise sales, a 27% increase from the tally in 2017. And while this is a record, we should also note that growth slowed from 39% last year. This as chair and founder Jack Ma plans to step down at the end of the year. For more, I want to bring in Kevin Carter, founder of EMQQ, the Emerging Markets Internet ETF, and Bloomberg Tech Selena Wang, both in San Francisco. So Selena, walk us through the numbers and the most significant things we need to be looking at here.
Right, we did see $30.7 billion in merchandise sales. That is a 27% increase, which is still quite impressive given that this is the 10th anniversary of this huge shopping bonanza. But that is significantly slowly from the 39% growth last year. Now, the metric that we're looking at is gross merchandise volume, and we need to take this number with a big grain of salt, because what that number tells us is the total amount of orders put through the system. It's not necessarily the total amount of sales, and it doesn't counter in in the potential returns. So it's actually not a great metric for consumer retail sentiment in the broader picture. Also, it's important to note that this giant number also includes sales that have been queued up from days before, so that the minute 11/11 hits, you see this massive order volume. And in addition to that, Alibaba has been able to continue to juice this number year after year because they continue to add new lines of business to this metric. So this was the first year that Lazada, their large Southeast Asian e-commerce site, was added into this as well. They've also been counting new delivery. For instance, they're doing Starbucks deliveries in certain cities during 11/11, as well as some of their offline-online retail integrations.
Now, Selena, our colleague Tim Kolpin in Asia has talked about how this GMV number that Alibaba uses is kind of meaningless because it doesn't have any sort of direct correlation to the ultimate revenue that Alibaba brings in. And he points out that there's a widening gap between the size of GMV and Alibaba's actual revenue. Kevin, should we be concerned about that?
Well, there's a lot of things to be concerned about in the world and perhaps in China, but no, I don't think so. I mean, look, this is a company that, when we last spoke, reviewing their most recent quarter, they grew revenue at 54%. And clearly, the GMV number growth rate has been declining, in terms of its growth rate. But no, 27% is a fantastic growth number. The company is, growing top line at over 50%. That will slow. The GMV number for Singles Day will slow. This is the law of large numbers. But the fundamental story here, the rise of the emerging market consumer, the rise of the China consumer is intact and going strong.
Selena, are other investors echoing Kevin's thoughts here, or are they a little bit more pessimistic?
Well, we are seeing the shares down of Alibaba more than 16%. So clearly investors aren't completely allayed by these positive Singles Day numbers. I mean, we are having to reckon with the fact that the Chinese economy is slowing, that there is the ongoing trade war between the U.S. and China that is somewhat dampening consumer sentiment. We also saw recent retail consumer data from China that was slower than expected. So we are hearing from management at Alibaba. Joe Tsai said during the Singles Day event that they're still confident in the emerging middle class, that despite any ongoing geopolitical tensions, Alibaba is riding the wave of this growing middle class that has expanding consumption capabilities. Now, that being said, we did hear when I spoke with Mike Evans, the president, last week, he did mention that sales of big ticket items were slowing, so like big flat screen TVs, refrigerators. However, they are seeing an uptick in growth of other consumer goods like cosmetics.
There's no sign now that we're through the midterms, Kevin, that the trade war, that either side is going to back down. How is that impacting your position in Alibaba?
Well, look, the emerging markets have been under a lot of pressure, right, in terms of the stocks and the ETFs that track emerging markets. And clearly the headline that's gotten the most attention, the thing that people are most concerned about are the trade war. There's also more recently, some undercurrents of is China slowing, is the Chinese consumer losing steam, and those may be true, but the secular story here is so much stronger and bigger than any short-term thing. I mean, this too will pass, and right now investors who have a mid to long-term approach to things, which every investor should have, should be looking at this sector as a place to invest because, as Joe said, the Chinese middle class, the emerging market consumer, these are long-term secular trends, and they're mashing into this other incredible and important and big secular trend, which is a smartphone, which is giving a computer to for the first time to billions of people and giving them internet access. And as they become consumers, they're doing it online through venues like Alibaba.
Joe Tsai, the other co-founder of Alibaba. All right, Kevin Carter, EMQQ, and Bloomberg Tech, Selena Wang, thank you both for weighing in. Well, Softbank is seeking to raise over $21 billion in the IPO of its domestic telecoms operation as part of the transformation of Softbank into a global investment company. The IPO would be Japan's largest yet. With us to tell us more, Bloomberg's Elizabeth Fournier. So, Elizabeth, we're continuing to get more information about the mechanics of this IPO, the size. What's new here?
So what we know now is the sort of very early sort of pricing indications. And what they said is they want to raise up to sort of 21 billion, which is a huge amount by any standards, and would absolutely be the sort of the biggest in Japanese history if it goes ahead at this sort of price. What we're really seeing here is the sort of the next stage of Masayoshi Son's sort of evolution as this Renaissance man. He wants to raise all this money, he wants to move away from this sort of traditional telecoms business, and he really wants to sort of cement his reputation as a tech investor.
So, the controversy involving ties to Saudi money, would you say that that is behind Softbank at this point? Or are investors concerned about that? And could we expect Softbank at some point to change its relationship with Saudi Arabia?
I mean, I think at this point we've not seen it have a huge effect. I mean, there'd been talk about this IPO raising up to 30 billion. So obviously, like, that's come down a little bit, but that's not uncommon in the early stages of these IPOs to have a sort of very large range that you're looking at for those numbers to narrow. I think what's more sort of interesting to investors here is things like the pressure from the Japanese government that this particular business is under to sort of lower fees, and also from other competitors. You know, there's new entrants onto this scene who've said that they want to steal a decent amount of market share.
So talk to us then a little bit about the broader telecom market dynamics and how the Japanese government plays into that.
Yeah, so there's sort of, you know, at the moment Softbank is the number 3 player in this market, and the government has said that they think that these companies have capacity to sort of cut fees by about 40%. Now, Softbank has said it can do that sort of behind the scenes by working on things like automation rather than having to hand those cost cuts right through the customer and for it to hit profits. But I think that's something that investors would definitely be watching after the IPO.
And once this happened, is Masayoshi Son then completely cut off from this wireless business? They have no ties.
Well, if you think about it, he's been building Softbank now for almost 40 years, and it's gone through all these sort of iterations. They're still going to own a big chunk of this business. They're selling down about a third. They still own sort of 63% of it, so they'll have some exposure. But I think the sort of, you know, the outward-facing part of the business is really switching this focus to what used to be a bit of a side hustle for him, those early investments in, you know, Yahoo and so on. And now it's really become the main focus with the Vision Fund.
All right, Bloomberg's Elizabeth Fournier. Elizabeth, thanks so much for bringing us that update. Bloomberg's Elizabeth Fournier. Well, Netflix will test a lower-priced version of its film and TV streaming service in some markets. CEO Reed Hastings says the company hasn't committed to lowering prices anywhere, but it does want to experiment. Netflix is looking for growth in countries where the per capita income is significantly lower than in the United States. Still ahead, we speak to the man in charge of keeping Accenture on the cutting edge of technology. Our conversation with Paul Doherty. This is Bloomberg. Welcome back to Bloomberg Technology at the Techonomy Conference in Half Moon Bay, California. Well, in the race to be leaders in deploying artificial intelligence, companies are often looking to government contracts, and not without controversy. From Amazon Web Services CEO defending its facial recognition software being used by U.S. immigration authorities, to Microsoft and Google employees protesting their companies pursuing defense contracts. To talk more about this, I want to bring in Paul Doherty, Chief Technology and Innovation Officer for one of the world's premier global management and consulting companies, Accenture. He is also the co-author of Human Plus Machine, Reimagining Work in the Age of AI. So, you know, I think an interesting question isn't necessarily will robots be taking our jobs, but will robots be sharing our values? And we see employees questioning, you know, how their companies and what their companies are building AI for. But what's your, do you have concerns about whether the AI that we're building will share human values?
Yeah, no, the way I look at it is technology is neutral. AI is neutral. We don't have to worry about AI taking over.
But humans build technology.
Yeah, the question is what do we as humans do with it? And there are new things we have to think about with how we apply technology. That's why when we look at artificial intelligence, we talk about something called responsible AI, which is how do you deploy AI to make sure it is living the values that we want to live, and it's fulfilling the outcomes and objectives you have as an organization. So for us, that means looking at things like the accountability for the algorithms, the transparency and explainability, fairness and making sure it's not biased, in terms of how it's deployed, honesty, and a human-centric approach. And if you follow those values, we believe you can apply AI for the right outcomes.
So what's your take on some of these controversies and companies that, to be fair, employ tens of thousands of people? Like, who's to say who they sell the technology to and who they don't?
Yeah, I think the way we look at it in our business is our mission is to help clients apply innovations that they can transform and run their business more effectively, serve their consumers more effectively. And we see a wide variety of how to do that across all industries and across the public sector, working with governments as well. So we look at it carefully. We actually have a process internally that we look at with our responsible AI principles of how we work and what kinds of programs we do, and we apply that to the way in which we create these outcomes for clients. And in doing so, we think you can both have your principles around AI and make sure that we're applying it with companies to design the right kinds of outcomes.
Now, there's also talk about how whether AI has hit a wall. It's supposed to be so smart, so transformative, and yet still make some stupid decisions.
No, well, the thing to understand about AI is not a human. It doesn't have human-level capability. It can do some very specific tasks that humans can do very well. It can recognize patterns. It can play games and things, but it can't be a human at this stage.
Are humans overhyping it?
I think it's overhyped a bit right now in terms of the human, the AI becoming human, but it's not overhyped in terms of the business potential. We believe AI has tremendous business potential. It's the fastest growing technology we've seen since I've been at Accenture 32 years, leading a lot of our technology waves. The fastest growing technology we've seen in that time, faster than cloud, mobility, internet, e-commerce in the initial wave. And that's measured by 19,000 people we have working in, technologists working in artificial intelligence for clients.
Is China ahead of the U.S. in AI in the short term and the long term?
You have to parse that question apart. China has a very clear articulated strategy in terms of the education, the workforce, data, and the technology of what they're doing, and that's setting them on a path that accelerating their progress to, I think they're in good shape for their goal of achieving leadership by 2025 and then by 2030 according to their plan. The U.S. has a lot of advantages. I'd say we're ahead right now in terms of research and development and application of AI. Europe is kind of working on their position with respect to AI. What I say in response to all that, it's too early to say who's really the winner. There's going to be hundreds and thousands of winners in the business adoption of AI across every industry sector. And the challenge for every company is figure out where you focus to create your advantage in the market.
I recently saw a story about Chinese researchers creating an AI news anchor. So, is my job safe?
I don't know. Is this the real Emily I'm talking to? I'm not sure. I think it's an interesting example that they developed. But we see that in many professions, in journalism, in medicine. The initial AI personas. It's going to be a long, long time before AI can replace what you do, which is understanding what's of interest to humans. How do you ask me the right questions to really get at the heart and context around the issues that we all face? And that's really what we have to focus on: is how do we accentuate the human capability of people and make sure that we are using technology to make us more human as a result. That's what we believe the real outcome of AI is.
So Accenture, 450,000 employees.
Yeah, over 450,000 employees.
Half of them are tech.
Yeah,
that's a lot.
We're a technology company. We're the largest technology services firm in the world. Applying innovation, developing innovative solutions to help our clients, do their business more effectively. And the largest part of our workforce is those who do coding, computer science, technology for clients.
So that's a huge sample size. What sort of trends are you seeing when it comes to women and underrepresented minorities in the tech portion of your business? Are you seeing improvements or not?
Yeah, it's a huge focus for us. We're big believers in an inclusive workforce, and we've set a goal to be 50-50 gender balance in our workforce by 2025. Well on the way to that goal at 40+%, starting where we are today and making good progress. And it's a big personal issue for me. I'm on the board of directors of Girls Who Code and support many other organizations, because fundamentally we believe with the world we're moving into, technology is part of changing our human experience and changing every aspect of our lives. And if we don't have an inclusive workforce at the heart of designing our future and building our future, it's not going to be the future we want. So that's why we're committed as an organization to true inclusion and diversity in our workforce and supporting that across tech any way we can.
All right, Paul Doherty of Accenture. Also important to making sure AI shares our values. Thank you so much for joining us. Coming up, the U.S. government is targeting a Chinese tech firm for stealing from U.S.-based Micron. We're going to speak to Micron CEO Sanjay Mehrotra next. This is Bloomberg. Welcome back to Bloomberg Technology at the Techonomy Conference in Half Moon Bay, California. 2 European mobile phone companies are in talks to build a 5G network in Italy. Bloomberg has learned that Vodafone and Telecom Italia would share the costs and accelerate the rollout of the high-speed connections. This partnership could include sharing wireless towers and radio equipment. A deal could be reached early in 2019. Well, first, the U.S. government took aim at ZTE, violating sanctions and nearly put the Chinese telecom giant out of business. Now, as we mentioned earlier, it is after a Chinese chip manufacturer accused of stealing tech secrets from an American chip maker, Micron. Joining me now to discuss, CEO of Micron, Sanjay Mehrotra. So, quite timing to have you here right now, Sanjay. You've accused 2 companies in China and Taiwan of stealing your IP, and now the DOJ has filed charges against them. Why do you think the U.S. government got involved here?
Well, I think it's very important that intellectual property of companies is protected in all geographies across the world, because a company like Micron, we just turned 40, and over 40 years we have invested billions of dollars into developing new technologies that are truly the heart of all the applications that are in the technology industry today. We make memory and storage that is absolutely critical for all technology applications of the future. So it's very important to protect our intellectual property.
You've talked about the new Micron. What does the new Micron look like?
The new Micron is Micron that's moving fast in terms of developing new technology and products that our customers need today, focused on cost competitiveness, focused on delivering high-value solutions, and in the process, absolutely driving greater shareholder value as well as greater value for all key stakeholders of the company.
Do you worry that the move by the DOJ risks ratcheting up the tension with China, given that China is your largest market?
China is a large market for us. We are very well engaged with the customers in China who very much appreciate the innovation capability that Micron is able to bring to them. We engage with these customers for all their applications, whether they are data center related or they are your mobile smartphones or related to various consumer or industrial applications. So China is an important market. Our customers value the technology and the products that we bring to them. Just note that we are one of the 3 companies in the world that provide memory and storage solutions. So our customers rely on us to bring advanced technology and solutions to them. We rely on them in terms of working closely with them to understand their requirements for the future, and we are very well engaged with the ecosystem of customers in China. And Micron, of course, also has some manufacturing in China as well as R&D. So we are an important partner to China. All we want to make sure is intellectual property is protected, and there is fair level playing field in the country.
So as you mentioned, you have facilities there, you have employees there. On the other hand, you have the Chinese government accusing you of antitrust. So how do you navigate that situation?
Well, we work with them, in terms of addressing any of their concerns. We absolutely openly work with them, and we are continuing to work with all aspects of our technology, our customer engagement, our manufacturing, as well as product development capabilities within China. And Micron is a global company. We are 34,000 team members worldwide, and we are very strong here in the US in terms of our R&D capability, our manufacturing capabilities, as well as designing products, and we are also well spread out throughout the globe. So very well diversified supply chain that the company has, as well as very well diversified footprint of R&D and manufacturing capabilities.
Any indication that now that Jeff Sessions is no longer head of the DOJ, that will change the course of action that the U.S. is taking in your case?
we appreciate the action taken by the DOJ in terms of protecting the intellectual property and theft of intellectual property by unauthorized companies. I do not expect that drive will change in any way.
You've been telling investors that the memory chip market hasn't changed. We're not seeing the mad rush to grab market share anymore. But I'm curious about the evidence that you're seeing because, another one of your executives told a UBS conference that there have been some inventory issues recently. How do we make sure that there's not some big downturn coming?
Well, we discussed in our September earnings call that, as is well known, that there are certain CPU shortages as well as certain inventory adjustments. But important thing is that memory and storage are in the very early innings of driving the growth and the experiences that are enabled, whether it is in the autonomous vehicles of the future, which are like data centers on wheels, really needing lot of DRAM and lot of flash, which we manufacture to ultimately truly process all that data that the sensors on the car will generate in order to provide for a safe, comfortable driving experience of the future. Or in the data centers today, in terms of really unleashing new business models, you need machine learning, artificial intelligence needs to process a lot of data. That data resides in the memory and storage solutions Micron makes.
Scale has always been important in memory. Samsung, huge competitor, huge market share, lots of capital. How do you compete?
We have strong scale of our own, and our focus is absolutely driving technology for cost competitiveness, but even more importantly, working closely with our customers to design the memory and storage solutions that they need in their applications in the future. And by that, what we mean is bringing high value solutions, such as solid state drives in your notebook computers or high performance memory in various data center applications.
We'll have to leave it there. Micron CEO Sanjay Mehrotra, thank you so much for stopping by. Good to have you and hear about the new Micron. That does it for this edition of Bloomberg Tech. Tomorrow we're going to be speaking to Max Levchin, PayPal co-founder and Affirm CEO, talking about the state of fintech. That's all for now from Half Moon Bay, California. I'm Emily Chang. This is Bloomberg.